What is a warrant? Warrants are usually derivative financial products issued by centralized financial institutions. It is a proof of buying and selling at a specific price in the future. Warrants are similar to options. They are both contractual certificates representing rights. That is, the buyer is the right party and has the right to buy or sell a specified quantity of the underlying commodity from the issuer of the warrant at a previously agreed price and time. The warrant holder has acquired a right rather than a liability. If the warrant loses money when it is being realized, the holder can also withdraw this right. However, the issuer only has the right of being realized. Therefore, to obtain this right, investors need to pay a certain amount of royalties. That is, they need to purchase warrants. Warrants are divided into call warrants and put warrants. If an investor is bullish on a certain currency, the investor can choose the call warrants. But if the investor is short on a certain currency, the investor can choose put warrants. Take warrant product BTC21 FEB 44000C-C as an example. BTC means that the target asset is the BTC USDT spot index. FEB means the expiry month of the warrant is the coming February. The first C means that the attribute of the warrant is a call warrant. If it is P, it means the warrant is a put warrant. The second C distinguishes the difference of the products purchased that expires in the same time period. The strike price, entitlement ratio, and expiry date are already set up when the warrant is issued. The strike price is the price agreed upon when the transaction is executed. Generally, the purchased warrant is seen as valuable when the underlying price reaches the strike price. The entitlement ratio is the number of warrants required in exchange for 1 unit of the target asset. Assuming that the entitlement ratio is 1, it means that investor can get the right to buy 1 BTC with 1 warrant. If the entitlement ratio is 10,000, it means that you have the right to buy or sell 1 BTC with 10,000 warrants. The expiry date is the final validity period of the warrant, and the buyer has the right to exercise the transaction at the strike price after expiration. The exchange will automatically liquidate the profit amount for users who hold the warrant. The warrants in the transaction are classified into in-the-money warrants, at-the-money warrants, and out-of-the-money warrants, based on whether the strike price is higher than the underlying price. To put it simple, if the profit after the exercise of the warrant, it is an in-the-money warrant, and if it is flat, it is an at-the-money warrant. Lastly, if loss is present, it would be an out-of-the-money warrant. The value of a warrant consists of 2 parts. One is the intrinsic value, that is, the profitable difference between the target asset price and the strike price at the time of exercise. The other is the time value, embodied in the premium, represents the expectations and opportunities of the holder for future target fluctuations. If it is an out-of-the-money warrant, the intrinsic value is 0, and there is only time value left, which is the possibility of future profit. The time value will gradually decrease to 0 as the expiry date approaches. Usually, the price of a warrant is also affected by the implied volatility. The greater the expected volatility, the higher the probability of profiting, and the premium of the warrant would become more obvious. Therefore, even if it is an out-of-the-money warrant, as long as it has not expired, there will be part of the time value left, and the value of the warrant will not be equal to 0. Warrants held can be traded arbitrarily before the expiry date. Finally, on the expiry date, if it is an in-the-money warrant at the time of settlement, the platform will settle for all warrant holders at the average price of the recent market. The settlement price of a single warrant is equal to the intrinsic value of the warrant divided by the entitlement ratio. The settlement of the warrant usually has 2 methods, in the form of the targeted asset or cash. Gate.io uses cash settlement, that is, using USDT to settle profit and loss. For example, if Xiaoming believes that Bitcoin will most likely rise in the future, but his available funds are limited, he can consider buying warrants. Say there is a warrant for BTC Feb CA with a strike price of $36,000 and an entitlement ratio of 10,000. Then Xiaoming bought 1,000 copies at a price of $0.1 and the total cost was $100. If the price of Bitcoin on the expiry date is $30,000, Xiaoming will buy $30,000 at the strike price of $36,000. Doing so, Xiaoming will suffer a loss. Thus, Xiaoming will choose not to exercise his right and will eventually lose $100 in warrant fees. If the price of Bitcoin on the expiry date is exactly $36,000, Xiaoming will not make any profit, even if he exercises his rights, and he will eventually lose the $100 warrant fee as well. If the final settlement price is $40,000, Xiaoming can use the strike price of $36,000 to buy $40,000 worth of Bitcoin. The right to buy is determined by the number of purchases entitlement ratio. Xiaoming has purchased 1,000 warrants, so he has the right to buy 0.1 Bitcoin with a profit of $400. However, since there is a sunk cost of $100, Xiaoming made a final profit of $300. On contrary, for example, if Xiaoming believes that there is a high probability that Bitcoin will fall in the future, he can consider buying put warrants. Assuming that the strike price is $32,000, Xiaoming's break-even point is $31,500. Only when the spot price is lower than this break-even point can Xiaoming sell Bitcoin at a price higher than the market value and make a profit. The lower the underlying price, the higher the profit. For our example, it is obvious that warrant and buying options present some similarities, and their profit curve is also consistent. The buyer's biggest loss will be the warrant fee, and the possible profit amount is unlimited. So, what is the difference between warrants and options? Difference 1. The buyer and seller are different. Option trading is a transaction between different investors. It is ordinary investors who sell this option, and the risk is borne by the investor. Warrants are issued by financial institutions and are reasonably priced by market makers with better liquidity, and the risk is mainly borne by the institution. Difference 2. Selecting conditions are different. Option investors can either buy or sell options. There are 4 directions for long and short trading, and hedging is also more flexible. Whereas warrant investors can only choose 2 directions to buy: call warrants and put warrants. Difference 3. Contract standard is different. The strike price, target asset, expiry date, etc. in an option contract are uniformly regulated by the market, which is a standardized contract and is mainly traded over the counter. The warrant is different. It is a non-standardized contract. The strike price, target asset, expiry date in the contract are controlled by the issuer and is traded in the exchange market. Difference 4. Different transaction thresholds. The multiple trading directions, Greek values, trading mechanism, and other factors involved in options are more complicated. The warrants are simpler than the option trading mechanism, and because of the presence of entitlement ratio, the face value is lower. Warrants have many advantages. 1. Built-in leverage effect, no collateral required. A little funds has a potential of unlimited returns. 2. Controllable risk warrant fee is the biggest loss. 3. Flexible operation can cooperate with a variety of combination strategies to hedge risks. 4. Applicable to extreme market conditions. Buy put warrants at the highest point and call warrants at the lowest point. Because the potential loss is small, the risk of bottom fishing is lower. Similarly, warrants also have some disadvantages. 1. Restrictions on time and strike price. Investors can only passively choose within a limited range. 2. Diminishing time value. Warrants will gradually depreciate as they approach the expiry date. 3. Complicated pricing, involving multiple effects such as intrinsic value, time value, and implied volatility. It is difficult to calculate expected profit. 4. Higher risk. If the strike price is not reached, the return on investment is 0. Therefore, warrant trading is a test of investors' sensitivity to the market. If the prediction of future volatility and direction is accurate, small funds can be used to obtain larger returns and the maximum loss is controllable. And if the prediction is wrong, the return on investment may be 0. Heavy stocking is not desirable. Investing in warrants must have complete investment knowledge, and users need to fully understand the potential risks before trading.